Welcome to Bloomberg Markets. I'm Scarlett Fu, the first trading day of the last month of the year, and we have record highs here for the S&P 500. It's a continuation of the steady melt-up that we've seen over the past 2 weeks. The S&P gaining about 0.25% right now. We're getting a pause in the U.S. Treasury rally, somewhat higher yields across the curve, although they've come in a little bit. There's a slew of economic data and Fed speak this week. There's also some competition from new corporate bond issuances as well. And the euro under pressure there, losing 0.8% against the dollar as France's government edges closer to collapse, possibly as early as this week. And you can see France's benchmark stock index, it did fall as much as 1.2%. Finishing the day little changed. Banks among the biggest losers there as a premium that investors demand to own French government bonds increases over German bonds. We're going to have more on that developing story shortly. But first, let's highlight some equity movers in the U.S. and check in with Abigail Doolittle, who has our midday check. Abigail.
Well, one midday mover that is really sky high. Take a look at the shares of Supermicro Computer at this point on the day, up 32%. This after an independent review found no signs of misconduct relative to accounting there. The professionals conducting that review are recommending, however, that the top financial and legal folks related to Supermicro step down. The CFO has stepped down. It's amazing that since this company brought on a new auditor, BDO, and has started working with the NASDAQ around filing the delayed 10K, the stock up more than 120% today, a big chunk of that. Turning to the shares of Intel, these shares are also higher, up about 4%, the better part of 4%, as the CEO is stepping down. Two longtime employees are filling the shoes of ex-CEO Pat Gelsinger, and the board is looking for a new CEO. The failed turnaround, apparently, and according to Bloomberg Exclusive, the board just became frustrated, disappointed. They want somebody new in there. The stock down about 50% on the year. That turnaround clearly not happening. And then finally, rounding it out, but to the downside, take a look at the shares of Stellantis, down 6.6% off of the lows. However, this is their CEO is leaving unexpectedly and early. These shares also down sharply on the year, down more than 45%. Lots of headwinds for the car space, including pressure on sales here sliding in the U.S., inventory issues in Europe. This stock really reflecting a lot of that uncertainty, Scarlett.
Absolutely, and that's a pretty dramatic decline there for Stellantis. Thank you so much, Abigail. I mentioned that there's anticipation ahead of big economic reports as well as Fed speak. Mike McKee, who is our editor covering international economics and policy, is here now with some comments from Raphael Bostic, so kind of the first of the Fed speak of the week.
Yeah, he's first out of the box for a very busy week for Fed officials, and basically he's saying that inflation is on a path, albeit bumpy, to the Fed's 2% target, and they just need to keep going in that direction. The Fed is tight at this point, he thinks, and they do need to adjust policy downward, but the path and how fast that happens isn't clear at this point because there are a couple of things on both sides of their mandate to worry about, and he had, Scarlett, some interesting examples. One is that the number of jobs created by small businesses opening has come down. And so that suggests that we're losing some steam in the labor markets, but also the number of jobs openings that were reported in those JOLTS report earlier in the year that were so large, he thinks their research shows that maybe those were exaggerated. So maybe the labor market is not contributing to inflation as much as they thought. So he's going to be following those things. He's going to be following the debate over the data that comes in for this week, the jobs report and the CPI, and then he'll make a decision about December. He still hasn't refined his view of how fast they would cut rates next year, but he says his estimate of the neutral rate is about 3 to 3.5%.
Okay, so he's very much data dependent up until the last minute here, and trying to parse through the noise. How has this affected the pricing of what markets think the Fed will do come December and in 2025? Well,
markets have basically backed off the idea that there is a certain path. The markets had priced in just before the last meeting, 100% chance of a rate cut in December. That's gone away now. It's about 65%. And of course, that'll get bounced around by the jobs report and CPI next week. It's really 2025 that the markets are very curious about. We'll get a new SEP. We'll get a new dot plot on December 18th. But those, how long will they be valid? We asked him today whether he's incorporating the Trump economic promises into his forecast. He says way too early to do that because they haven't been fleshed out. We don't have the details. We don't know exactly how he's going to.
And that really echoes what Jay Powell had said during the last FOMC presser when everyone was throwing him questions, hypothetical questions really, about the incoming administration. You said that this kicks off a big week of Fed speak. We know that Jay Powell will be speaking on Wednesday, but around Jay Powell's comments on Wednesday, what else can we anticipate?
Well, you've got a couple of other Fed officials who are going to be talking about these things, including Tom Barkin from the Richmond Fed, who just added 2 speeches today. Chris Waller is talking later today about the Fed and its framework review that begin, and there's a lot of questions about that are not immediately impactful in terms of Fed rate cuts, but how the Fed will look at data going through the next years. And so there's a lot of things to keep an eye on, but Jay Powell, of course, being the premier event of the week for Fed speak.
All right, and it'll be a moderated discussion, so he's going to be answering questions. So there will be a release text as well?
He may have some text remarks, but I suspect if he's going to say anything, it'll be in the Q&A.
All right, good stuff. Michael McKee, thank you so much, Bloomberg's international economics and policy correspondent. Let's turn back to France, where the far-right National Rally Party of Marine Le Pen will back a motion to topple the French government after the Prime Minister of France failed to agree to all of its demands on next year's budget. Bloomberg caught up with the country's finance minister yesterday, and here's what he had to say about the situation at that time.
The French government doesn't take ultimatums. It's looking at the French parliamentary debate. It's respecting each and every parliamentary debate that leads to an evolution. We will take into account what is changing, but we won't be blackmailed. We are committed to reduce the deficit.
All right, this is a developing story, of course, and we've been keeping up to date on the latest movements here. So on the ground in Paris is Bloomberg Paris Bureau Chief Alan Katz. Alan, there's been a new development once again where the French premier has offered some kind of final hour budget concession. Where do things stand right now?
So that's already a few hours old at this point, and that's gone by the wayside. So what we had was the government came in this afternoon, and Michel Barnier, the French Prime Minister, he used a constitutional procedure called Article 49.3, where you adopt a bill without a vote. In other words, you say the government is taking its responsibility. This bill becomes law, and Parliament doesn't vote on it. But what that does is that opens up the government to a no confidence vote. And so what's happened is the government has adopted a budget bill. It's for part of the budget. It's not the whole thing. This is just for the Social Security portion of the budget. But they adopt now the National Rally and a coalition of left have either filed or are going to file no confidence motions against this government. Now, the way it works in France is that there has to be at least 48 hours between the time you filed that motion and when it can be voted on. So between now and Wednesday evening, we're sort of in a holding pattern. And from that point on, there could be an actual no confidence motion in the French Parliament that could then throw out Michel Barnier's government.
Okay, you mentioned Michel Barnier's government. He's a relatively new prime minister, but he may go down as one of the shortest serving PMs in France. What about Emmanuel Macron? I mean, what is his standing? And at the end of the day, isn't he kind of the one calling the shots?
So normally, yes, but Emmanuel Macron dissolved parliament back in June, and we had elections. And the parliament that was elected at the time was split really between sort of 3 camps, basically a left, center, and far-right camp. And as a result, Macron's party and its allies no longer had a majority or even a sort of a relative majority in parliament. They became actually relatively small in parliament. And that suddenly switched the French system from basically a presidential system to basically a parliamentary system. What that means is that Macron is still in office. No one can force him out. He could resign if he wanted to, but he can't be pushed out. You sort of think of him like a U.S. president. Mm-hmm. But Parliament suddenly, where you have to pass bills like the House and the Senate, became controlled. Well, it wasn't really controlled by anybody. And so the person Macron ended up naming, Michel Barnier, just a few months ago, as you mentioned, isn't from Macron's party. He agrees with Macron on lots of things, but disagrees with him on others. And even Barnier had no sort of majority within Parliament. And so what we're coming to is that to even pass the most basic of legislation, right? What we'd call like must-pass bills in the United States, the budget. He's unable to get a group of legislators large enough to be able to pass that budget. And even if then he uses this constitutional measure to pass it without a vote, he's opened himself up to a no confidence motion that he's very likely to lose, because the left-wing coalition plus this far-right party, the National Rally, are going to come together. They've said that they're going to vote against Barnier for this, which means they're extremely likely to have an absolute majority. That means at least 289 votes in Parliament, and that they really will push him out of office. And so Macron has very little authority in all of this. His position remains, but he can't really affect how this plays out, at least over the next few days. After that, he can, but we can come to that in a second if you want to.
All right, Alan, I think that does it for us in terms of kind of setting up the scene here. Alan, really appreciate your staying for us. Bloomberg Paris Bureau Chief Alan Katz joining us there. Now, for more on what the latest developments could mean for markets, for investors, I want to bring in Andrew Kenningham. Andrew is the Chief Europe Economist at Capital Economics, and Andrew comes to us from London. So, Andrew, all of this is quibbling or arguing over France's budget. At the end of the day, will France be able to reduce its budget deficit, or are the far right and the far left teaming up to squeeze Michel Barnier and his leadership to the point where we're just going to have a standstill and a government shutdown?
Well, yeah, I think as your colleague explained very well, looks like there's going to be there'll have to be a new election, but it won't happen until the middle of next year. In the meantime, assuming the government is voted out, there might be some kind of technical government in place, which Macron will be able to appoint. I think that's what Alan Katz was alluding to. So that government may then try to push through the kind of fiscal adjustment which Michel Barnier has been trying to do. But it would be a temporary arrangement, only for 6 months, and then we'd have new elections. And the problem is that would probably produce a very similar parliament, which would be split between these three different groups. And it seems there's not likely to be any clear mandate for any particular group to push through the reforms that are needed. That's what the markets are concerned about.
And that concern is reflected in euro weakness, the euro losing 0.9% against the dollar. It's down about 1% versus the yen, and French stocks teetering. They did finish unchanged on the day, but also what people are calling le spread, which is the gap between French and German 10-year bond yields. What does it signal specifically? What is the concern that investors are expressing?
I think ultimately the question is about how creditworthy France is. So there is some differentiation now between different Eurozone government bond yields, which is quite a healthy thing, because some governments are in a better position than others. And France has been losing ground to other countries in southern Europe. So Spain and Portugal, for example, have been doing much better than France in terms of their growth rate and in terms of their fiscal policy. So the spreads for those countries are now lower than they are than France is. And in fact, Greece was almost the same as France the other day. I think the problem is that it's likely to continue this downward trend for France. So things are getting worse in France, and it's very difficult to see that turning around. And I think investors will continue to shift towards countries like Spain, Portugal, Greece, which used to be the problem countries within the Eurozone, as they're now seen as being somewhat better credits than France.
So that begs the question, and I know that there's going to be hyperbole here, but is France the new Greece? I mean, could it end up in a situation similar to Greece where those bond yields really get blown out?
Yeah, it's an interesting comparison which a politician in France made, and it's quite a natural one from a political perspective. But the fact that the spreads are the same on France and Greece is really telling you more about how much Greece has improved. France is nowhere near as bad a situation as Greece was back in 2010 at the beginning of the Eurozone crisis, where, frankly, it was insolvent. There wasn't just a question mark over creditworthiness. So I think we're a very, very long way from that. And it's also interesting that the peripheral countries in the south, there's not even been any sort of significant contagion to them. Their yields have not risen, despite the problems in France. And that, to some extent, that's probably testament to what the ECB has done over the last, decade, really. It's created a number of tools which would allow it to step in if things got too hairy.
Well, I'm glad you bring up the ECB, because they have their next policy meeting and decision due out in about 10 days. We know they've already cut interest rates twice. How much does the ECB respond to this, address this, or even care about this?
Yeah, they've cut interest rates three times now, from 4 to 3.25%. It looks pretty certain they'll cut by another 25 basis points on the 12th of December. They will be watching this very closely. It's interesting, the governor of the Bank of France, who sits on the council of the ECB, has been sounding very dovish recently. So he's clearly keeping an eye out for his own country's situation. But the ECB's mandate overall is to look at the entirety of the Eurozone and to hit an inflation target. So as long as there isn't a much bigger sort of widening of spreads or a lot of contagion to the south, then I think they'll be able to continue with their monetary policy based on concerns about inflation and the normal monetary policy issues, which in my view means that they'll move pretty swiftly to bring interest rates down next year because the Eurozone as a whole is struggling. Yeah.
And I'm glad you corrected me on the interest rate cuts, 3 of them. I kind of forgot about the one that took place in early June because it predated the U.S. Cycle. And, we're so U.S.-centric here. Very quickly here, you mentioned about ECB intervention. There's something called the TPI bond purchase program. How likely is it that the ECB might tap that?
Yeah, this is their latest emergency sort of lending rescue program, which I think probably some of them would quite like to have a chance to use it, but it's certainly not suitable to use it for France. It's intended to be used to dampen contagion, which is unwarranted. So if there were a blowout in yields in Italy or Greece or something, that's where they could come in and help those countries if it's being caused by something in France. France's problems are self-inflicted, and so they won't use the TPI in that case.
Okay, so they're worried about contagion and less a reflection of the specific mechanism within France. Andrew, really appreciate your time. Thank you so much.
Pleasure.
Andrew Kenningham is Chief Europe Economist over at Capital Economics in London. Coming up, we are going to turn back to the U.S. as Cyber Monday is upon us. Kearney Consumer Institute lead Katie Thomas will be joining us for a closer look at U.S. retail spending this holiday season. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for the stock of the hour, and we're looking at Gap. Shares are getting a lift today after JPMorgan upgraded the Gap to overweight from neutral. And this follows a meeting with Gap's CEO Richard Dickson and CFO Katrina O'Connell. And of course, it's a crucial few weeks for retailers with the holiday season underway in the U.S., the keyword there being few because of the late arrival of Thanksgiving this year. For more on the state of U.S. retail, I want to welcome Katie Thomas. Katie is the lead at the Kearney Consumer Institute. It is a unit within Kearney Holdings. Katie, good to speak with you. What do the early numbers show about Black Friday spending and how that sets us up for today, which is Cyber Monday?
Yeah, Scarlett. So this year's actually off to a strong start. Just this morning, MasterCard came out with a report that said Black Friday, specifically that day, sales were up 3.4% over last year. And that's right on the top end of the overall holiday spend target that NRF put out, estimating a 2.5% to 3.5% growth versus last year. Some of what they shared was actually online was already up and in-store sales were a little bit softer. But what we're really hearing from consumers is it's not just gifts, which they do love shopping for, but it's also that they've been waiting to get good deals on items that are personal for their own personal use, and they really want to make sure they get their own bang for their buck. But it overall sets the holiday season up for success.
Yeah, it's funny you mentioned that because our floor director, Matt, was just telling me he was buying a pair of jeans from Duluth Trading Company, and it wasn't a present, it was a gift to himself, I guess, just something that he had his eye on. So we talk about how this is Cyber Monday, just like we talk about how there was a Black Friday, but we know that these deals have been really promoted for the days and weeks leading up to Black Friday. What is actually on offer on a day like today or this week compared with in years past?
Yeah, so like you said, I mean, Black Friday really dates back to when there were doorbusters and Black Friday was in store. And Cyber Monday actually was before we were all on the internet and shopping online so much. People would go back to work and actually have faster internet connections and shop online. It certainly is all blurred together now. But with Cyber Monday specifically, what you tend to see is that final push And it may include some extra discounts and deals, particularly actually with apparel organizations. They really like to throw that, extra 15% off or extra percentage off sales, whereas electronics, those do tend to really start to be on sale around Thanksgiving, Black Friday, and that kind of holds pretty steady. So you're just looking for that final great deal today. And then throughout the rest of the month, it'll be more kind of specific categories or segment, deal of the day.
So that's interesting because for anyone who procrastinated and didn't get in on the Black Friday or Cyber Monday or Cyber Week deals and are still kind of waiting for some price point to get in on, are they kind of at the mercy of retailers who might be exercising more dynamic pricing? I really need to move this, so I'm going to mark this down, but none of this is all set in stone.
Yes, absolutely, Scarlett. I would say it's a little bit depends on how strict you are to your list. So do I want exactly the brand, exactly the item I had in mind, or am I a little bit flexible in terms of what headphones I'm buying? But if you're looking at some of the popular items this year, for instance, every year UGG slippers still tend to have a popular item. The big colors and the big sizes are probably already sold out. So it really depends, again, how strict you want to be. There will definitely still be deals, but it will be a little more variable. You're not necessarily going to see the whole store on deal. You're going to start to see, fast shipping deals come into play. So it's just going to be more variable.
All right. So that means a lot of scouring on the internet, certainly. Katie, always appreciate your joining us. Katie Thomas from the Kearney Consumer Institute. From New York, this is Bloomberg. I'm Scarlett Fu. Let's check on markets and where things stand right now before we close out the hour. We're looking again at a record high in the S&P 500, and if it closes at these levels, this would mark the 54th closing record this year. The Nasdaq 100 actually doing better with Tesla and Apple climbing to new highs. Euro weaker versus the dollar, down 0.9%. This is Bloomberg.